I'm Sarah Borkson-Keeter with NarREITsREIT.com, and I'm here in Las Vegas at REITworld 2015, NarREIT's annual convention for all things REIT. I'm joined by Jed Reagan, Senior Analyst at Green Street Advisors. Morning, Jed.
Morning.
So, Jed, development is an important aspect of the real estate business in both the public and private markets. How does Green Street view development, and what are some of the considerations that come into play when you're valuing development in an NAV?
Sure. So I would say Green Street in general has, I would describe as a healthy skepticism about the development business. I think it's a business that when it works, it can work in a big way, but there are definitely risks that come along with development that I think can be underappreciated sometimes. For one thing, it can be very difficult to time development. I think a lot of companies in the past have sort of gotten out over their skis at just the wrong time in the cycle and gotten burned. It also can create additional development, funding risk, and that can put additional pressure on balance sheets. That's a concern. And then it also can be costly to carry a development platform over a full cycle, particularly in a downturn if essentially development is dormant. So that's a factor as well. I think for all those reasons, what we've seen over time is that active developers actually tend to underperform less active developers. Which I think is interesting and may not be fully appreciated. As far as how we think about valuation, what we'll do is in our models for every development project that a REIT's pursuing, we will assign a profit margin based on sort of our expected economics of that deal, and then importantly we'll go and assign what we think is an appropriate hurdle rate for a given project based on sort of the risk characteristics of that project. And so, for instance, if you have an office development that might have a 50% profit margin potential, but it's in a risky market, or there's a lot of competing supply, or fundamentals are softening. The hurdle rate that we assign to that project may be quite high and take a huge bite out of the potential profit margin. So sort of the overall value creation potential is much more muted. So that's kind of how we approach that.
And what are you seeing nationally in terms of office development at this point in the cycle?
I would say generally, for office supply, it's been really a silver lining for the sector up to this point in the cycle. Demand in office has been, pretty weak, but yet since supply has been held at bay for the most part, it's been a positive and kind of helped support pretty good pickup in fundamentals in this cycle. We are starting to see development creep back into the conversation, and in a handful of markets, particularly tech-focused markets like the Bay Area, Seattle, Austin. We're seeing a fair amount of supply so far. They've been getting soaked up pretty well in those markets, but we're certainly keeping an eye there. And then energy-driven markets like Houston in particular is a market that we're concerned about. You're seeing a lot of supply, including spec supply, coming online at the same time that demand is starting to trail off in a pretty meaningful way. But the outlook overall for office supply is for it to remain pretty moderate and be, I think, not a big concern.
How are office REITs approaching development these days, and are there any causes for concern?
Well, office REITs have definitely been getting more active on development as this cycle has moved along. I would say for the most part, they've done a pretty good job so far in this cycle, and there's been some successful projects. I think they've been generally pretty disciplined in terms of pre-leasing risk, as well as not sort of putting too many eggs in one basket at one time. We are starting to see REITs getting a little bit further out on the risk spectrum in terms of pre-leasing risk, and also we're starting to see REITs growing their pipelines even more, even though NAV discounts are starting to increase and cost of capital is starting to weaken for a lot of REITs. So that's something we're definitely keeping an eye on. And then we're also looking at balance sheets as something we're always mindful of risk around development funding, and something over time we'd like to see REITs position themselves with conservative leverage so that in the event of a downturn they're going to be relatively well positioned.
Okay, thanks very much, Jed.
Thanks for having me.
And for more news and information on REITworld 2015, be sure to visit REIT.com.